A very good afternoon to all friends. I'm Sanjeev Singhal, Central Council Member and Chairman Auditing and Assurance Standard Board and Sustainability Reporting Standard Board. I, on my behalf and along with my Vice Chairman, CA Vishal Doshi ji, welcome you all to the 88th program of AASB for this council year. Friends, so far 1,02,000 plus members have joined our programs. And it's heartening to note that even though there are unstructured CP hours, still members are joining in large numbers. This year, AASB has taken many initiatives. We had bank audit expert panel. Similarly, we have just concluded the statutory audit expert panel, in which more than 50 experts were available day and night to answer the audit-related queries of our members. Besides, we are working on various technical aspects in the sphere of auditing. And today, I'm happy to share that the topic is examination of prospective financial information and compilation engagement. This is indeed a very important topic, because what is the auditor's responsibility and what is the method that he should follow while examining the prospective financial information, or where he is invited for doing the compilation engagements. And these are dealt by the auditing standard SA 3400 and SRS 4410 revised. Friends, we have organized webinars on every topic within the auditing sphere, all auditing standards, all guidance notes, Schedule 3, CARO, each item of a financial statement, and now we are taking specialized topics. We strongly urge you, because auditing is fundamental to our profession, we strongly urge you to kindly attend these programs and ensure that you stick to the auditing standard and the literature and the auditing literature in letter and in spirit. We are joined by our esteemed, very senior council colleagues here, Ranjit Agarwal from Eastern region. And Ranjit Agarwal ji is also known as father of UDIN. He was the one who introduced UDIN, and which is now replicated by most of the regulators in India and the professional institutions outside India. He has brought glory to the profession through UDIN. He has also been the chairman of the Ethical Standard Board, and now very ably leading the Committee for Member in Industry and Business. And under his leadership, the number of vacancies have exceeded the number of applicants. So much so that this year we also revised the minimum salary of the chartered accountant in campus to 9 lakh rupees. And basically the CMIB is making unprecedented forward steps under his leadership. Thank you, Ranjit Bhai. Thank you for agreeing to be a keynote speaker. We also welcome CA Harshvardhan Dosa for being the technical speaker for the program. Welcome, Harshvardhan ji. And before I invite Ranjit Bhai, my vice chairman and a very, very able hand in the council, one of the finest addition to the 25th council, is also here. I will request for his opening remarks, and then we will request our keynote speaker, Ranjit Bhai, to deliver his keynote address, and then we'll be inviting our technical speaker for the day. Thank you, and over to you, Vishal.
Thank you very much, Sanjeev Bhai. A very good afternoon, friends. I take this opportunity to welcome all the participants, our senior council colleague, Ranjit Bhai, and the speaker, Harshvardhan. And friends, let me share with you the happiness that I feel when we are saying that we have executed 88 technical programs of learning from the AASB this year, and this year by which we would mean that in a span of about 6 months. And also the level of participation, the interest that our members have shown across the various spheres of the technical subjects that we have covered. In fact, it gives us not only happiness, but it gives us a lot of motivation to do further, do more and more for the benefit of our members, by which the assurance standards or the audit and assurance standards, which are forming the backbone of our profession, we are able to inculcate more and more technical knowledge. We are able to impart that knowledge, and we are able to also get a comfort that the members are showing interest in ensuring that they are able to apply that on a daily basis when they are executing various assignments. Friends, the topic that are being discussed today, in my view, they are some very, very important standards, and which as professionals, though they are not relating to the historical financial statements, but they are very important because I think Sanjeev bhai, Ranjit bhai, Harsh, everybody would agree that in our routine day-to-day interaction with members, we receive a lot of questions, whether the trial balance unaudited financial statements or pro forma financial statements, they can be certified by a chartered accountant, under which standard they can be certified, what is the nature of assurance that is required to be given, what about the projections, because many of our members clients, they go for loans, they go for borrowings where they are requested to give certify, I would say, the future financial statements or the numbers. And these are the typical questions which, though not directly related to the historical financial information, but are definitely an area which concerns most of the practicing chartered accountants. And therefore, these two standards, like the chairman rightly mentioned, the SAE 3400 and the SRS 4410, covering the examination of prospective financial information and compilation engagements, I am confident that Harsh would be able to respond or cover in his presentations these normal questions that are being asked by our fraternity at large. So once again, I welcome all of you to this webinar, and thank you for giving me this opportunity.
Thank you, Vishal bhai. And now I would request my elder brother and senior counsel colleague Ranjit bhai for his keynote address.
Thank you very much, Sanjeev bhai and Vishal bhai, chairman, vice chairman of this very, very important AASB, and the kind of phenomenal job you have done this year, 88 webinar, and this support to the bank audit queries and other publication you are bringing. It's very, very encouraging and very satisfying to both of you and for the membership at large also. And very respected speaker Harshvardhan ji and very able professional who are joining this webinar. Friends, this is a topic which is very close to my heart also, because when we have designed the UDI concept and the booklet of the UDI, for these two standards, we have added a separate chapter as SAE 3400 and SRS 4410. 99% cases, the memberships are getting requests from the banks and the client to certify the financial statement, which are prospective or compilation of the accounts, which they are not authorized or not mandated to do so. But in the pressure and on the professional assignment they are getting, they are doing. So we have educated this concept to most of the members at large, and how to certify this projected financial statement or compilation of the account, and whether the UDI is required, whether I can do the certified true copy, a piece of paper or income tax return or a balance sheet which I have not signed, whether I can certify that balance sheet which has been signed by another member. Lot of these kind of query come, and we have tried to resolve all these query in our UDI publication as well. Today topic also talk about whether as a member of the professional institution like ICI, we have been mandated to certify or we have been mandated to make an opinion on the data provided to us. Whether we can certify as a true copy, that is also a question mark, because certification of true copy is done by a gazetted officer and not by the chartered accountant, because Supreme Court also said CAs are not a gazetted officer. So we are here to make an opinion on the data supplied to us. And very well, we can make a certificate, we can make an opinion and generate a UDI and charge the fees also. If you go to this Chartered Accountant Schedule 1, Part 1, Schedule 1, Clause 10 talks about that any certification or a assurance given on the subject to issue, which are uncertain or percentage of profit, is a professional misconduct. If you talk about the Schedule 2, Part 1, Clause 2, which talks about if you are certifying anything without the substantial data and the record, it is a professional misconduct. So considering these two clauses, whether as a member, I can certify projected balance sheet? No. Whether I can do unaudited balance sheet? No. But we have given by the institute a very, very nice two standard, SAE 3400 and SRS 4410, And let me tell you, these SAE 3400 was given by the ICI in 1982. 1982, these standards are there, which has guided the member. You cannot certify the projected financial statement, but we can give this statement certificate in the form of SAE 3400, where they have given a format. In this format, with the disclosure, you can very well certify, and on this basis, you can also generate the UDI and also. So our speaker will deliberate in detail how these two standards are there. But as a member, as a practicing member, we are not permitted to certify the future projected balance sheet or a compilation account. If you talk about that, whether I can certify a non-corporate balance sheet which are not subject to audit, yes, you can do. Illustration 5 of essay 700 examples are given. So on those lines, everything is given, guidance given by the ICI. For every certificate we are giving, we have a standard guidance note on certificate for other purpose revised in 2016 given by AASB. This guidance note for all kind of certificate, this guidance note is there, which has been revised in 2016. So if you go through the material of institute alone, you are not only protected yourself, but you are also giving assurance function which is required by the various regulator. So with these words, I compliment AASB for bringing at the table these two very, very important standards, and these will be deliberated by Harshvardhan in detail. And if you have any query, you can also ask in the chat box, which can be answered by us. So thank you very much for this presence list.
Thank you very much, Ranjit Bhai. The fluency with which you quoted the sections and gave the history, that last 40 years this is there, and that's the benefit of a senior counsel colleague by your side. In fact, if you really see 3-generation council colleagues, or other council colleagues from 3 councils are there. Ranjit Bhai is a council member from 23rd council. I'm a member from 24th council, and Vishal Bhai is a member from 25th council. That's a unique combination. Thank you, Ranjit Bhai, and over to you. Over to our learned speaker, C.A. Harshvardhan.
Thank you, Sanjeev sir. Thank you, Vishal sir, and thank you, Ranjit bhai, for the wonderful introduction. And as I'm learning also today that AAASP has completed 88 sessions and trainings in this calendar year, and it is a privilege to be part of such an institute where knowledge is so freely shared with all the members and all the fraternity as a whole. Our topic for today, as has been introduced, is on examination of prospective financial information and compilation engagements. We will be covering 2 essays. One of them will be SAE, that is standard on assurance engagement, and another will be standard on related services. These are just general disclaimers that that are there. So, like I said, SAE 3400 examination of prospective financial information and SRS 4410 compilation engagement. In fact, since the time that we have been CA students, many times there is a notion that these standards may not have some certain importance, but the more daily challenges that we are facing, the more ease of business that the government is doing. Both these standards, assurance engagement on prospective financial information and compilation engagement, are gaining more and more importance as even small to medium-sized practitioners today are venturing into the field of compilation engagements as well as examining the prospective financial information. Just to give you a brief idea, even SEBI today, I think around a month ago, SEBI had released an article that they wanted to understand the basis on which valuations are done for all the currently listed companies which are being listed. So in that sense, as members, as CAs and as members in practice, it becomes our duty to follow these standard on assurance engagements and related services, to have a proper engagement documentation, as well as to prove to SEBI that yes, we have been following the guidelines which have been issued by ICAI and AASB. So let us start first by understanding the basic framework with which this was built. So the structure is such that the first framework is the framework for quality control in all kinds of engagement, which includes quality control for firms that perform audits and reviews of historical financial information, other assurance, and related service engagements. So if you see out here, this is covered by our SQC1, which is the standard on quality control. Now, it not only talks about the historical financial information, it also talks about quality control for other assurance engagements as well as related service engagements, which are our topic for today. Along with the second framework is framework for assurance services, which include audits and reviews of historical financial information, which is covered by standards on audit 100 to 999 and standards on review engagement. Also, assurance framework for assurance services includes assurance engagements of other than audits and reviews of historical financial information, which is governed by SA 3400 in our situation today. Lastly, the framework for related services includes engagements of related service such as agreed upon procedures, compilation engagements, and other related services, which is SRS 4400 and 4410. So we will be covering these two standards. And point to be noted that the framework for quality control is also applicable to SAE 3400 as well as SRS 4410. Now here, we just recently discussed, the kind of assurance that we as members in practice can give on all these various types of assignments or all these various types of engagements, just briefly summarized out here. In auditing, we always give a reasonable assurance, that is a high level of assurance, and the report also that we give in our statutory audit is a positive assurance, where we mention that in our opinion the financial statements are true and fair, subject to whatever qualification remarks are there. In review and assurance engagements, we give a more moderate assurance, and in the report provided, we often give a negative assurance on the assertion, saying that nothing has come to our attention that makes us believe that the statement is incorrect. And in related services, which includes both agreed upon procedures and compilation engagements, we do not provide any assurance. These are just factual findings. So in agreed upon procedures, we just give our factual findings, what are the actual factual findings. And in compilation engagements, we just identify the information that is compiled. We do not attempt to verify the accuracy of the information, but we are only responsible for the compilation engagement. Before we actually start with the specific topic, just wanted to point out the Qrb observations on these two standards. When we read the Qrb observation of last 2 years, that is 1920 and 2021, one of the observation was that not establishing in engagement quality control review, not establishing policies and procedures, setting out criteria against which all other audits and reviews of historical financial information and other assurance and related service engagements should be evaluated to determine whether an engagement quality control review should be performed. Now, as per para 60, the requirement of SQC1, it says that the firm should specifically establish policies and procedures requiring for appropriate engagements and engagement quality control review that provides an objective evaluation of the significant judgments made by the engagement team and conclusions reached in formulating the opinion, including the firm should set out criteria against which all other audits and reviews of historical financial information and other assurance and related service engagement should be evaluated to determine whether an engagement quality control review should be performed. Now, in the past, it may so have happened that since there were no engagements of assurance services or there were no related services engagements being performed by any specific firm, these were not included as part of SQC1. But now, as these standards become more and more prominent, and as more and more small and medium-sized practitioners are venturing into this standards of examining prospective information as well as compilation engagements, it becomes very important for the firms to modify their policies in accordance with SQC1. So this is just an overview of the standards that we will be covering today. Let us move on specifically to Standard on Assurance Engagement 3400, examination of prospective financial information. First and foremost, let us understand what do we mean by prospective financial information. It is the financial information based on assumptions about events that may occur in the future and the possible actions of by an entity. Now, it is very nicely drafted in the sense where it talks about events that may occur. So there is no guarantee that this event will occur. And also the possible actions by an entity. So today, as chartered accountants, as CAs in practice, when we are certifying or when we are giving a report on prospective financial information, we will be specifying in the report that this will be based on the possible actions by an entity, whatever has been communicated to us. We are not going to give a guarantee that yes, whatever prospective financial information has been disclosed out here, the entity is going to be achieving it in the future. It is highly subjective in nature, and its preparation requires exercise of considerable judgment. Prospective financial information can be in the form of a forecast, projection, or a combination of both. For example, it can be a 1-year forecast plus a 5-year projection. So out here, there is a need to define two more words, which is forecast and projection. Here they are saying prospective financial information may be a forecast, or it may be a projection, or it may be a combination of both. Let us understand the difference between forecast and projection. A forecast is prospective financial information prepared on the basis of assumptions as to the future events which the management expects to take place and the actions that the management expects to take as of the date of information is prepared. So this is more, you may say, a little high level assurance compared to projection, where what the assumptions are that what is actually expected to take place. Whereas if you see the definition of projection, in a projection, prospective financial information is prepared on the basis of hypothetical assumptions about future events and management actions, which are not necessarily expected to take place, such as when some entities are in a startup phase or are considering a major change in the nature of operation, or a mixture of best estimate and hypothetical assumptions. Now, here it is important to note here where they specifically mention where some entities are in a startup phase, which will be covered by a projection phase. Now, when the entity is in a startup phase, we do not know the length or the extent to which the entity can grow or the extent to which the entity may not grow. So therefore, it is included in a projection. Today, when we will be reporting on prospective financial information, we need to identify whether the information provided to us is in the form of forecast or is it in the form of a projection, and accordingly give our report and on the same. The purpose is to establish standards and provide guidance on engagements to examine and report on prospective financial information, including examination procedures for best estimate and hypothetical assumptions. Further, the principles laid down in other standards on audit should be used by the auditor to the extent practicable in applying the standard on assurance engagement. The word auditor is not necessarily statutory auditor of the entity's financial statement. So SA 3400 uses the word auditor, but in essence, it can be synonymous with practitioner in the case. It does not necessarily mean the statutory auditor of the entity. Uses of preparing prospective financial information. Prospective financial information includes financial statements or one or more elements of financial statements. It may be prepared as an integral management tool. Sometimes simply the management wants to understand and assess the entity. So prospective financial information may be made solely for the management to assist in evaluating a possible capital investment, or for distribution or submission to third parties such as potential investors, like Mr. Chairman said, even lenders or bankers, or in a prospectus in the annual report to provide information to shareholders or any other regulatory bodies, or in a specific document such as cash flow forecast for information of lenders. More often we get a question that then is it that examination of prospective financial information is the same as valuation? No, that is not the case. In an examination of prospective financial information, we are simply providing a report on what can be the prospective financial information. We are not certifying, or we are not arriving at a value of the company based on the prospective financial information. To arrive at a value of the company or to arrive at a valuation would be going one step further of diving into the prospective financial information and arriving at the value based on the prospective financial information. So it is completely different from a valuation. We cannot say that it is the same or it is similar to valuation. Further, the standard gives management's responsibility. The management is responsible for preparation and presentation of the prospective financial information, including the identification and disclosure of sources of information, the basis of forecast, and the underlying assumptions. We will understand in a little while why this point is extremely important, where management is responsible for identifying and disclosing the sources of information, the basis on which the forecasts are made, and what are the underlying assumptions for the prospective financial information. In the case of auditor's assurance, we as auditors or practitioners are not in a position to express an opinion as to whether the results shown in the prospective financial information will be achieved. It is sorry, it is difficult to obtain a level of satisfaction sufficient to provide a positive expression of opinion that the assumptions are free from material misstatement. When reporting on the reasonableness of management's assumption, the auditor provides only a moderate level of assurance. As we discussed in the examination of prospective financial information, we do not give a reasonable assurance, we give a moderate level of assurance. And in the sense, in our report, we will be giving a negative report that nothing has come to our attention that makes us believe that the prospective financial information is incorrect. So that is the auditor's assurance and the management's responsibility section. However, as we discussed, both PFI and compilation engagements are subject to SQC1. So before acceptance of engagement, factors to consider in accordance to SQC1 are as follows. What is the intended use of the information? The information is going to be general or for limited distribution, whether the information is going to be for general use of the public or it is specifically for distribution to the bankers, etc. If the information is specifically for distribution to specified people, in the report, it has to come out that this information or this prospective financial information is prepared only for the limited distribution to so and so person. What are the nature of assumptions which are used? What are the best estimates or the hypothetical assumptions? Also, the elements to be included in the information and what is the period covered by the information. The practitioner should not accept or the practitioner should withdraw from the engagement if the assumptions stated by the entity are clearly unrealistic. Now, before accepting an assignment on prospective financial information, a preliminary check in statutory audit, we call it as risk assessment procedures. Out here, a preliminary check may be made in the sense to check whether the assumptions are unrealistic or the assumptions are hypothetical. The hypothetical assumptions and unrealistic assumptions are two different things. Hypothetical assumptions may be achieved when certain factors happen. But if the assumptions are clearly unrealistic and if the practitioner believes that the entity will never be able to meet these assumptions, they should not be accepting such an assignment. Also, if it believes that the PFI will be inappropriate for its intended use, in that case, the practitioner should not accept the assignment. In accordance with SA 210, which is your agreeing the terms of audit engagement, it is necessary that the auditor and the client should agree on the terms of the engagement, and it should be signed by both the practitioner as well as the client. Also, the practitioner needs to obtain knowledge of the business of the client, obtain sufficient knowledge of business to evaluate all significant assumptions, internal control over the system used to prepare the PFI. Just like statutory audit, we need to evaluate the internal control system, documentation supporting management assumptions. Whatever management's assumptions are there, as auditors, we need to obtain sufficient documentation, which can be either from within the entity or from outside the entity. Extent to which statistical, mathematical, and computer-assisted techniques are used, what are the methods used to develop and apply the assumptions, and what is the accuracy of prospective financial information prepared in prior periods and variances. If the entity has prepared prospective financial information in the previous years, it's a very basic check that if in the earlier years the entity has prepared prospective financial information for next 5 years, in that case we should check the actual figures of the later years with what was projected or what was given as the prospective financial information earlier. So if it is more so accurate, it serves more as a documentation purpose that yes, whatever prospective financial information the entity is giving may be to an extent accurate. Also should consider the extent to which reliance on entities' historical financial information is justified. Sometimes it may not be completely accurate to simply rely on the historical financial information. For instance, if we take the last, now COVID is almost over, but if we take the year before that in 2020 or 2021, the historical financial information may show a very reduced nature of operations. In that case, it may not be completely relevant to only simply look at the years of 2020 and 2021. It may also be better to place reliance on more previous years, and also to understand management's perspective on the basis of scale of operations that the entity is planning. The auditor would consider relevant facts and effect on the examination of prospective financial information. If the audit or review report or prior period historical financial information was not a clean report, or the entity is in a startup or an expansion phase. Again, if the previous year's historical financial information was not a clean report given by the statutory auditor, then he needs to consider what impact that may have on the prospective financial information. More often than not, when we as auditors qualify a report or give an adverse opinion, we quantify the amount wherever possible. We quantify the amount by which the item is materially misstated. In that case, that needs to be taken into account while examining prospective financial information. The factors which are relevant in determination of nature, timing, and extent of examination procedures. What was the knowledge obtained during the previous engagements? What is the management's competence? If the auditor or the practitioner has been involved and has had an assignment with the entity, they know the competence of the management in preparation of preparation of the prospective financial information. If the auditor is confident that yes, management is competent enough and they are changing the assumptions on a rational basis, in that case the auditor can rely on the management. If not so, then the auditor needs to do a more detailed checking as to how he obtains assurance that the assumptions applied are realistic. What is the likelihood of misstatement? What is the extent to which the PFI is affected by the management's judgment? If the management has applied judgment in the sense, very basic, that let's say for example there was one entity who was recently entering into India in a retail market. Now, when the entity is entering into the retail market, first couple of years will definitely go into massive expansion scale. In that sense, the auditor may obtain as to how many stores the entity is planning to open in a particular city. Similarly, he can obtain how many stores the entity is planning to open in the state and in the country. And then based on how many stores the entity is planning to open, what will be the number of items sold per store, and accordingly arrive at the total revenue figure. And then the auditor needs to check to what extent this PFI is justifiable. The auditor also needs to obtain the source of information from where this is likely. For example, the sources of information can be very simple internal sources, or it can be external sources. Internal sources would include budgets or forecast, or the matters which are described in the prospectus of the entity, and so on. What is the stability of the entity's business? If it has been if the entity has been in business over the past number of years and now is going for prospective financial information, is the entity's business stable enough to grow to a more larger extent? The auditor needs to judge that. Also, what is the engagement team's experience in the prospective financial information? When hypothetical assumptions are used, all significant assumptions are taken into consideration. They should be consistent with the purpose, and it should be realistic. The assumptions which have been used should be realistic assumptions. They should focus on areas sensitive to variation and which are material. Now, here it becomes important that the practitioner should understand what is the purpose of the prospective financial information and where is the user's attention going to be drawn. Whichever area the user's attention is going to be drawn, be it profit before tax or be it revenue from operations, there the auditor needs to focus on those areas more. And also, it should focus on those areas where where the variation may be higher. If the engagement for individual component, consider interrelationship of other components. So if the engagement is for simply for cash flow forecast, or it is simply for a statement of profit and loss, consider what relationship it will have even on the other component of the balance sheet, such as sales will have a direct relationship with your customers, that is debtors balances. Your purchases will have direct relationship with your trade payable balances. So those interrelationship needs to be considered. Another example, very basic example, could be a depreciation example. When the entity is in a startup phase, it is going to be acquiring more and more fixed assets. So in the initial years, the depreciation may be higher, and later on the depreciation may reduce. Just basic interrelationship of other components needs to be made. Also, the auditor shall obtain written representation from the management regarding the intended use of the prospective financial information, the completeness of significant assumptions. Now, this is a very crucial point where the auditor should specifically obtain from the management completeness of the assumptions. Whatever assumptions that the management has been using to prepare the prospective financial information, the auditor has to obtain that in writing from the management. The management's acceptance of responsibility for PFI. Again, this would be covered in the terms of engagement as per SA 210. In the case of presentation and disclosure, the auditor shall consider the requirements of relevant statute, regulation, and professional pronouncements, and also consider whether presentation is informative and it is not misleading. The accounting policies and assumptions are clearly disclosed in the notes to prospective financial information, and the date of preparation is specifically properly disclosed. The basis of establishing points in a range is clearly indicated. Now, many times it may so happen that in the case of prospective financial information, the entity is not giving an exact number, but entity is giving a range. So what was the basis for establishing those range also needs to be indicated in the final report. The adequacy of disclosure, if any change in the accounting policy. Just like historical financial statements, in the case of prospective financial statement, if there is going to be a change in accounting policy, why is there going to be a change in accounting policy has to be considered as per the relevant accounting standard or the relevant NDS. As part of documentation, the auditor shall document matters important in providing evidence to support his report on the examination of prospective financial information, and that such an examination was carried out in accordance with this particular standard on assurance engagement. What are the contents of the report which are required under SAE 3400? As we can see, very basic and very some of them will be similar to your normal stat audit opinion. Out here, the title and addressee, then identification of the prospective financial information. What is the prospective financial information that we are reporting on? Reference to applicable standard on audit or standard on assurance engagement. What are the specific responsibilities of the management? When applicable, a reference to the purpose as to why this prospective financial information is created, and the restricted distribution. If the financial information, if the PFI is not to be distributed to all to the general public, but is to be restricted and only distributed to specific bankers for the purpose of obtaining loan, a reference to that has to be made. A statement that examination procedures included in examination on a test basis. Now, it is very obvious that as examiners of PFI, we will not be in a position to examine all the transaction all the items at the transaction level. So we will be checking the same on a test basis. So test check basis checking has been done. A statement has to be provided. There should be a statement of negative assurance and also an opinion whether the PFI properly prepared on the basis of assumptions and presented in accordance with the relevant financial reporting framework. Also, the appropriate caveats concerning the achievability of results need to be stated. This is very important point here. As practitioners, we are not giving a responsibility, or we are not saying that yes, whatever is mentioned in the prospective financial information, the entity will be achieving the same. So we need to give appropriate caveats that the achievability actually depends on the entity and circumstances of the case. This is just what prospectively the financial information could be. Also, the date of report, place, and signature has to be mentioned. It is important to note that reference may be made to clause 3 of part 1 of the second schedule, where a chartered accountant can participate and review the financial forecast or projection, provided the report clearly mentions what is the sources of information, what are the bases of forecast, and what were the major assumptions made. And specifically, the report should not vouch for the accuracy of the financial information. Again, if this is not done, the CA in practice will be deemed to be guilty of professional misconduct. So whenever we undertake engagements and as per SA 3400, a noting has to be made, or a reference has to be made to clause 3 of part 1 of second schedule, which clearly states that these 4 things have to be mentioned in the report. So in the auditor's report, it should mention what was the sources of information, what was the basis of forecast, of basis on which the forecasts were made, what were the major assumptions used for those forecasts, and the fact that the practitioner does not vouch for the accuracy of the information. There are 3 types of reporting. One, there could be a qualified or an adverse opinion, or withdraw from the engagement if the auditor believes that the presentation and disclosure is not adequate. Now, if the auditor clearly believes that the presentation and disclosure of the prospective financial information is not adequate, he may simply withdraw from the engagement. The auditor may give an adverse opinion or withdraw from the engagement if he believes that one or more significant assumptions do not provide a reasonable basis for the prospective financial information. And he may give a disclaimer of opinion or withdraw from the engagement if the examination is affected by conditions that preclude the application of procedures considered necessary in the circumstances. In that case, he may give a disclaimer of opinion. Also, in the case of prospective financial information, the auditor's report should specifically state whether anything has come to the auditor's attention which causes the auditor to believe that the assumptions do not provide a reasonable basis for the prospective financial information. Again, the statement will come in a negative confirmation that nothing has come to our attention that makes us believe. So here we are giving a moderate level of assurance. We are not giving a reasonable assurance. Also, the report should state whether PFI is properly prepared and presented in accordance with the relevant financial reporting framework. Now, the financial reporting framework may be any financial reporting framework. It can be Ind AS basis or on accounting standards basis. But whatever is the financial reporting framework that is adopted by the management, the PFI has to be prepared on that basis. The actual results are likely to be different from the PFI since anticipated events frequently do not occur as expected, and the variation could be material. Like we discussed, we are not giving accuracy of the prospective financial information, so the actual results are likely to be different from the PFI. When the PFI is expressed as a range, it would be stated that there can be no assurance that actual results will fall within the said range. So, there is often a misconception that, if there is a range specified in the prospective financial information, in reality or whenever actual results come, they will be falling within such range. So to avoid that confusion or to avoid that misconception, the report must specifically mention that even though a range has been given, there is no assurance that the actual results will fall within that specific range. And in the case of a projection, where prospective financial information has been prepared using a set of assumptions that include hypothetical assumptions about future events and management's action are not necessarily expected to occur. And lastly, consequently, readers are cautioned that PFI should not be used for other purpose other than the purpose for which it is intended to be used. These specific things need to be mentioned in the report. Here, what I've done is we've just given an illustrative format of the unmodified report in case of a projection. If we read to the title has to be given, whatever is the title, report on examination of prospective financial information. Addressee also must be mentioned, whoever is the addressee. And it must be mentioned that we have examined the projection of so-and-so entity or so-and-so project for what period to what period. The period has to be specifically mentioned. as given in the prospective financial information from page so and so to so and so, in accordance with the standard on assurance engagement SA 3400. The examination of prospective financial information. The preparation and presentation of the projection, including the underlying assumptions set out in note so and so to the prospective financial information, is the responsibility of the management. So here, very clearly, we have to indicate that the preparation of the projections are the responsibility of the management, and they are not the practitioner's responsibility, and has been approved by the board of directors, be it the same as those charged with governance or be it different from those charged with governance. Our responsibility, as in the practitioner's responsibility, is simply to examine the evidence supporting the assumptions, excluding hypothetical assumptions and other information in the prospective financial information. Our responsibility does not include verification of the projection. Therefore, we do not vouch for the accuracy of the same. Again, a linkage out here can be made to the Chartered Accountants Act, where it specifically says that the CA in practice can undertake such an assignment as long as he does not vouch for the accuracy of the prospective financial information. Further, we can see that the projection has been prepared for so-and-so purpose. Again, specifically in the report, it has to be mentioned for what purpose the projection is being made. Coming to second para on the second line, based on our examination of the evidence supporting the assumptions. Again, here, how do we as practitioners give a negative opinion is mentioned out here. Nothing has come to our attention which causes us to believe that these assumptions do not provide a reasonable basis for the projection, assuming that whatever are the assumptions that are being made by the management. For the in the last para, it is important to note what they mention is that in our opinion, the projection is properly prepared on the basis of assumptions set out in so and so note to the prospective financial information and on a consistent basis with the historical financial statement using appropriate accounting principles. So it is very interesting that this has to be clearly specified that no matter what prospective financial information the management is giving, it has to be on appropriate accounting principles. The basic accounting principles cannot be broken even in the case of prospective financial information. Even if the events anticipated under hypothetical assumptions described above occur, actual results are still likely to be different from the projection, since other anticipated events frequently do not occur as expected and variation may be material. This is specifically required to be mentioned so that nobody takes it for granted that yes, today as if a CA in practice has certified or has stated that they have verified the prospective financial information, this is how it is going to be happening. No, that is not the case, and hence it has to clearly be coming out in the report on prospective financial information. That is it for prospective financial information. That is our SAE 3400. Generally, we get a question whether UDIN is required for the prospective financial information or prospective financial statement. Yes, the member has to comply with SAE 3400 while drafting the report for such engagement and has to obtain UDIN for the same. So that is it for prospective financial information. Moving on to our second topic, that is compilation engagements. Just 1 second. So, the government of a country has more so believed and is believing in ease of doing business. In that case, there may be a possibility that the limit for statutory audits may be increased or may be removed. In such a scenario, more and more small and medium-sized practitioners will go for compilation engagements, wherein they will be assisting the management of the entity to prepare the financial statements. In that sense, this particular SRS 4410 revised, becomes extremely important and extremely crucial for us to understand as members. The effective date of this SRS is 31st March 2016. Now, one major change out here was that in the earlier SRS, the word auditor had been mentioned. Now that has been replaced to the word practitioner out here. So maybe you may expect that there may be a change in SAE 3400 also, where the word auditor can be replaced with the word practitioner. So that is one of the major changes in SRS old and SRS revised. The scope is that it deals with the practitioner's responsibilities when engaged to assist the management with the preparation and presentation of historical financial information without obtaining any assurance on that information, and to report on the engagement in accordance with this SRS. As we discussed, in the case of SRS, compilation engagement, the auditor does not obtain any specific assurance. Without obtaining any assurance, it is the practitioner is simply doing a compilation job and is assisting the management for preparation and presentation. Ultimately, the preparation and presentation of financial statements or historical financial information is always the responsibility of the management. Here, the practitioner is simply assisting the management in that preparation and presentation. It applies to compilation engagements for historical financial information. However, it may be applied or adapted in compilation engagements for financial information other than historical financial information, example, prospective financial information. So this is where there is a linkage between our previous standard that we just covered, SA 3400, and this standard SRS 4410 compilation engagement. Now, it specifically mentions that it applies to compilation of historical financial information, but it also says that it may be adapted as necessary for other than historical financial information. So the principles of this standard on related services may be adapted as necessary for compiling the prospective financial information as per the previous standard that we just covered, and also for compilation engagements of non-financial information. So it is not so that compilation engagements can be only of financial information. Compilation engagements may also be for non-financial information, such as greenhouse gas statements or CSR reporting, environmental reporting, etc. So all this will be covered under compilation engagements. Further understanding the scope, financial information that is subject of a compilation engagement may be required for various purposes, including to comply with mandatory periodic financial reporting requirements established in law or regulation, such as we have a quarterly reporting for listed companies, or we have annual reporting for unlisted companies. In that sense, the financial information may be subject to compilation engagement. Further, for the purposes unrelated to mandatory financial reporting under relevant law or regulation, including for management of those charged with governance internal use, for periodical financial reporting undertaken for external parties under a contract or a form of engagement. Example, financial information provided to a funding body to support the provision or continuation of a grant, or for transactional purposes, for example, to support a transaction involving changes to the entity's ownership or financing structure for merger or acquisition. So compilation engagement is not only limited to periodical reporting, or is not only limited to reporting on financial statements. It can be for other reporting other than financial statements as well, where it can be for submission of the bankers, or it can be submission to external party under a contract when they have to justify the use of funds for a specific grant, and so on. In a compilation engagement, the practitioner applies accounting and financial reporting expertise and assists the management in preparation and presentation of financial information of the entity in accordance with applicable financial reporting framework, and reports as required by this SRS. So, like we discussed, all the quality control requirements are also applicable to an engagement in compilation engagement. In the case of compilation engagement, the practitioner shall apply accounting and financial expertise to assist the management in preparation of the financial statements. However, it shall be in accordance with the applicable financial reporting framework. Now, just like in a statutory audit, one of the precondition of audit is the acceptance of management or use of management of an applicable financial reporting framework. Even in this case, the management should be using the applicable financial reporting framework. For instance, if the turnover or if the net worth of the entity exceeds 250 crores and Ind AS is applicable, then the AFRF and the financial statement should be prepared in accordance with that specific AFRF. So here it is the basic duty of the practitioners to understand what should be the financial reporting framework that is applicable to the entity, and to ensure that that specific AFRF is being complied with. The basic premise of compilation engagement, the base in which the compilation engagements are to be undertaken. First, it is to be understood that it is not an assurance engagement. There is no requirement to verify the accuracy and completeness of information provided by the management. Also, there is no requirement to gather evidence to express an audit opinion or review conclusion. Two very simple points, but very heavy points. First, in the case of compilation engagement, we as practitioners have no responsibility or no requirement to verify the accuracy and completeness of information. Whatever the management is going to be providing to us, or whatever the management is going to be giving to us, simply that has to be compiled with. Also, there is no requirement to gather evidence to express audit opinion or review conclusion. In the case of compilation engagement, we are not giving any specific opinion. So if we are not giving any specific opinion, in that case, since we are giving no assurance, there is no requirement to gather any evidence. Whatever has been the data that has been submitted to the practitioner, only the same has to be compiled and given back to the management. Management still ultimately retains the responsibility for the financial information and basis on which it is prepared and presented. In no scenario it will so happen that if the management is outsourcing, or if the management is giving the assignment of compilation engagement to another practitioner, the management will lose responsibility for preparation and presentation of financial statements. The preparation and presentation of financial statements of a company especially is still and will remain the responsibility of the management. However, as practitioners, we will simply be compiling the information and providing to the management. SRS 4410 does not impose responsibility on management of those charged with governance, or it does not even override laws and regulations with regards to the responsibility of management and those charged with governance. Again, it is not that SRS 4410 is saying that management is responsible. The law and regulation which are applicable to the entity may mention that the management of those charged with governance are responsible. In the case of companies, the law and regulation, that is the Companies Act, specifically mentions that the management is responsible for preparation, presentation of financial statements. So the preparation of financial statements, books of accounts is the responsibility of management. That cannot be done away with of the management of the entity. Compilation engagement done in according to SRS 4410 is based on the premise that management has agreed to certain responsibilities fundamental to the performance of the engagement. Here it becomes so crucial and important that we need to have a engagement letter or a letter of engagement agreeing to the terms and conditions and agreeing to the basis on which this compilation engagement exercise is going to be undertaken. So that needs to be covered in as per SA 210. The value of a compilation engagement. Compilation performed in accordance with SRS 4410, an application of financial and accounting and financial reporting. Compliance with standards. There has to be compliance with standards, including ethical standards in regards to SQC 1. But we will understand one important ethical standard which need not be complied with. We will understand that in the coming slides. There should be a clear communication of the nature and extent of the practitioner's involvement. Clearly, it should be communicated what is going to be the involvement of the practitioner. Also, interesting to note, what this SRS 4410 also mentions, that along with compilation engagement, the practitioner may also be employed by the entity for collation of data, for gathering or for maintenance of books of accounts. So that those parts are not covered in this SRS. But as soon as the practitioner is compiling those information and giving it and presenting it, then this SRS becomes applicable. So as of yet, for collating the information or for classifying the accounts, accounting records correctly, that is not covered in this SRS. Only the compilation of those accounts and to be presented in accordance with in accordance with applicable financial reporting framework is covered in this specific standard. There are two conditions in applying SRS 4410. The practitioner is engaged to compile historical financial information and to provide a report for engagement in accordance with SRS 4410. So here the practitioner has to be engaged to compile historical financial information. However, it may be adopted and modified as necessary for SA 3400, which is for prospective financial information. Also, under SRS 4410, the practitioner is also supposed to provide a report for the engagement in accordance with SRS 4410. We will also be understanding the basic one report, illustrative report we'll be going through as part of the presentation. Compliance with SQC1, as we discussed, it applies to the firm with respect to its compilation engagements. The provisions of this SRS regarding quality control are premised on the basis that the firm is subject to SQC1. But the deficiency in firm's quality control system does not necessarily mean that the engagement was not carried out in accordance with professional standards and legal and regulatory requirements, or that the practitioner's report was not appropriate. Here, they've automatically given a caveat where they are saying that yes, compliance with SQC1 is required for compilation engagement. However, if there is a deficiency in the firm's quality control system, it does not necessarily mean that the engagement was not carried out in accordance with professional standards. The engagement may still have been carried out in accordance with professional standards, and the practitioner's report may still hold appropriate, even though there may be a deficiency in the firm's quality control system. So this is an exception that is given in this particular SRS. What are the requirements of the SRS? This is just a summary of what are the requirements of this specific SRS, and then we will move on to all these requirements in detail. First, there should be a conduct of a compilation engagement in accordance with this SRS. The practitioner has to comply with ethical requirements. There must be professional judgment involved. Should be the engagement level quality control? Again, this comes as part of SQC1. What should be the engagement, acceptance, and continuance relationship? Communication with management and those charged with governance. While actually performing the engagement, what should be kept in mind by the practitioner? What documentation should the practitioner be maintaining? And what should be mentioned in the practitioner's report? Let us understand all these requirements in detail. Just one second. Conduct of a compilation engagement in accordance with this SRS. The practitioner should have an understanding of the entire text of the standard on related services to understand its objectives and to apply the requirements properly. The practitioner should comply with each requirement of this SRS unless a specific particular requirement is not relevant. Example, if circumstances addressed by the requirement do not exist in the engagement. Not represent compliance with this SRS unless complied with all the requirements of this SRS relevant to the compilation engagement. So even if one of the requirements of this SRS has not been complied with, then he should not represent in his report that compliance has been done in accordance with this SRS. So this needs to be specifically taken into account at the time of reporting. Basic ethical requirements which are required: integrity, objectivity, professional competence, due care, confidentiality, professional behavior. All this comes from SQC1. However, one very important point to be noted: independence is not a precondition for compilation engagements. So today, when we are preparing or we are undertaking an assignment of compilation engagement, independence is not a precondition, because as such, we are reporting on this specific compilation engagement to the management, where we are assisting the management itself to prepare the financial information. So independence is not a precondition. This has to be very clearly communicated and has to come out in the auditor's report, in the practitioner's report as well. Professional judgment. There is a need to exercise professional judgment. The need in interpreting ethical requirements and SRS requirements, making informed decisions throughout the engagement, and assisting the management in deciding about the acceptability and application of financial reporting framework. At least to a basic extent, there should be a need to apply professional judgment to assist the management in deciding whether the financial reporting framework adopted is acceptable or it is not acceptable. Also, at the same time, the management or the practitioner shall exercise professional judgment based on the facts and circumstances of each case known to the practitioner Also from the knowledge of from the other engagements undertaken for the client, and understanding of client's business and operations, and extent of management judgment required in preparation and presentation of financial information. Here, just like SA 315 asks the auditors to identify and assess the risk of material misstatement through understanding the entity and its environment, this specific SRS also requires the practitioner to understand the client's business and operation. Just because it is not the responsibility, or we do not give any opinion on the compilation engagement, does not mean that we should not have an understanding of the client's business, because based on the understanding of client's business, we will be able to identify what are the judgments which are used by management, and based on those judgments used by management, we will be in a better position to come to a conclusion as to how the entire information has to be compiled. So it is not so that there should be no need to understand the engagement, the business of the client, or there should not be a need to determine materiality. All that will still come as part of this SRS, even though as practitioners we are not providing any report on the same. Next point is the engagement level quality control. Ultimately, the engagement partner shall take responsibility for the overall quality of each compilation engagement to which that partner is assigned, and the engagement being performed in accordance with the firm's quality control policies and procedures by following appropriate procedures for client acceptance and continuance, by ensuring the engagement team's competence and capabilities. Just basic requirements of SQC1 as well, that the engagement team has to be competent. Regular training should be given to engagement team before commencing the engagement. Also being alert to indications of non-compliance by members of engagement team with relevant ethical requirements. Again, independence is not one of the ethical requirements required for this particular SRS, but other relevant ethical requirements should be complied with even by the engagement team. And directing, supervising, and performing the engagement in compliance with professional standards and applicable legal and regulatory requirements, and also taking responsibility for the engagement documentation. So it is not so that just because we are doing compilation engagement, the responsibility or even the requirement for documentation goes away. The documentation requirement will still be present and be extremely relevant, because today if we have to prove that the same was compiled properly based on the evidence available to the practitioner, the only thing that will safeguard us as practitioners will be our documentation, that these were the assumptions made by the management, and this is not an assumption made by the practitioner. These were the assumptions which were made by the management. This was the information that was provided by the management or those charged with governance to the practitioner. All that needs to be specifically documented at an engagement level. Also, for engagement acceptance and continuance, the practitioner shall not agree unless the agreement with management or engagement partner on terms on what are the intended use or what is the restriction on use of the distribution of financial information. You see, everywhere they're using the word financial information and not financial statement, because it may be financial statements, it may be specific financial information. There needs to be an agreement on the management between the management and the engagement partner on what is going to be the use or what is going to be the restriction on use of the financial information. What is going to be the identification of financial reporting framework? Now, if the basis or the premise of identifying financial reporting framework may not be complete, and according to the practitioner, for example, Ind AS is applicable, whereas the management is insisting that no, the financial information has to be prepared in accordance with our regular accounting standards. In that case, the practitioner should not accept the assignment in the first place itself. What are the objectives and scope of the engagement? What will be the objectives of the practitioner? What will be the scope of the engagement? What will be the scope of the practitioner? What will be the practitioner's responsibility with regards to ethical requirements? What will be the management's responsibility? Ultimately, management is responsible for the preparation and presentation of financial statement. The practitioner is not the practitioner is simply responsible with compilation of the engagement. or what will be the expected form and content of the report. So as such, before entering into the compilation engagement or at the time of creating an engagement letter, it should be specifically stated what will be the form and content of the practitioner's report. If these basic things are not in agreement between the management and the engagement partner, then the compilation engagement assignment should not be undertaken. Just like SA 210, record the agreed terms in the engagement letter or other suitable form of written agreement prior to performance of the engagement. So prior to commencing the engagement, all the terms and conditions should be mentioned in the engagement letter, which is also a requirement of SA 210, and it has to be signed by both the parties, by the engagement partner as well as the management. Communication with management and those charged with governance. Communication with the management should be on a timely basis of all the significant matters and what is the nature of the matter and expected action to be taken by the management or those charged with governance of all matters concerning the engagement, which in the practitioner's professional judgment of sufficient importance to merit attention of the management and those charged with governance as appropriate. So just to give a basic example, if at the time of compilation engagement, we as practitioners come to know that provision for gratuity needs to be created, and the provision for gratuity is not created by the management or those charged with governance, we can bring this to the attention of the management on a timely basis. That this particular provision needs to be created in the books of accounts, and once this is created, we can include it as part of the compilation engagement. However, even though it is not a responsibility or we are not giving an opinion on the compilation engagement, still something that is on prima facie not followed and needs to be followed, needs to be informed to the management and needs to be communicated with the management. While performing the engagement, performance of engagement is divided into two parts. First, what will be the practitioner's understanding, and second will be the compiling the financial information part. So let us understand first what will be the practitioner's understanding, what the practitioner has to understand. The practitioner should obtain sufficient understanding of the business and operations of the entity, including the accounting system, the accounting records, and what is the applicable financial reporting framework. So before commencing the engagement or at the time of commencing the engagement, the practitioner has to obtain specific sufficient understanding of the business and operations of the entity. They also have to understand what are the accounting systems and how are the internal control systems of the entity being functioned, and have an understanding of accounting record and what is the applicable FRF to the specific entity. Also, establish a frame of reference to exercise professional judgment. Based on the understanding obtained, the practitioner has to establish what the frame of reference within which he is going to exercise professional judgment. The depth and breadth shall be lesser than that of the management. Again, the ultimate responsibility for preparation and presentation of financial information will remain with the management. The depth and breadth of the responsibility will be lesser than that of management. There should be a level sufficient to enable compilation under the terms of engagement, and it has to be an ongoing process. So understanding the business of the entity or understanding business and operations and accounting system will be an ongoing process. It cannot be a one-time process and then it will be stopped. Next, coming to actual compilation of the financial information. Compile using records, documents, information, etc. that is given by the management. Discuss with the management or those charged with governance sufficient judgments for which assistance is provided. Now, there may be many situations or many cases where judgments are required by the management in case of provision for warranty, provision for after-sale services, or something as simple as provision for ECL or provision for bad debts. In that case, whatever judgment is required by the management needs to be communicated with the management on a timely basis. Before completion, the practitioner shall read the compiled financial information vis-a-vis whatever is the understanding that he had obtained about the entity. In case there is incomplete, inaccurate, or unsatisfactory records or information provided by the management, bring it to the attention of the management and request for additional or corrected information. So if during compilation engagement, we come to know that there were certain incomplete records or there were certain inaccurate or unsatisfactory records. On the spot, we need to bring it to the attention of the management and request for additional or corrected information. We cannot then at that point of time say that, even if the records are incomplete, it is not a responsibility. It is our basic responsibility to the sense that if we know that something is incomplete, we need to bring it to the attention of the management. If the management is unable to complete the engagement because the management fails to provide the requested records or information, the practitioner shall withdraw from the engagement and inform reasons to those charged with governance. However, if the management provides the requested information and propose appropriate amendments, if it becomes aware that AFRF is not adequately referred or not adequately described, or that the compiled financial information requires amendments to prevent being materially misstated, or CFI are otherwise misleading. If any of these three situations occurs, then as a practitioner, it becomes our responsibility to propose the amendments, because even though ultimately management is responsible for presenting the financial statement, we are assisting the management in presenting the financial statement in accordance with the applicable financial reporting framework. Now, if the AFRF is not adequately described, or it is not adequately presented and disclosed, or if the CFI requires amendments which need to be done as per the AFRF to prevent it from being materially misstated, in that sense, as practitioners, we need to propose amendments to the management. If the management declines or does not permit the amendments, withdraw and inform the management and those charged with governance the reasons why the withdrawal is happening. If withdrawal, however, also is not permitted, determine what will be the professional and legal responsibilities of the practitioner. Obtain an acknowledgement of the management of those charged with governance that they have taken the responsibility of final version of CFI, and the practitioner has no final responsibility on the compiled financial information. Documentation, the practitioner needs to document a record of matters of continuing relevance to future compilation engagement and to fix accountability on the engagement team. And who had performed the specific work, who was the reviewer, and who was the person who had performed the work. It includes documentation what all needs to be included in the documentation, what were the significant matters that arose and how they were addressed. So similar to a statutory audit, what were the significant matters that arose during the compilation engagement and how they were addressed by the management. How compiled information reconciles with the underlying records, accounting information, etc. So basically, simple books of accounts, copy of books of accounts may be required, based on which we can say that, okay, the final financial information reconciles with the underlying books of accounts. The final financial information for which management, those charged with governance, has acknowledged its responsibility, and the practitioner's report. So these four basic things need to be documented. And as such, if you see, all these basic things are already mentioned even in SA 230. They are additionally included in this specific SRS. Coming to the elements of the practitioner's report, the basic element is the report title. What should be the title? Then the addressee, as required by the terms of engagement. More often than not, it will be the management. A statement that the practitioner has compiled the financial information based on information provided by the management. See, whatever information has been compiled has only been compiled based on information provided by the management. So the practitioner does not take a responsibility of the completeness of information. Whatever information has been provided by the management to the practitioner has been compiled with. So that statement has to specifically come out in the practitioner's report. A description of the responsibilities of management or those charged with governance in relation to the compilation engagement and the financial information. What are the responsibilities of the management? What are the responsibilities of those charged with governance has to also come out. Identification of AFRF, and if it is a special purpose financial reporting framework used, a description or reference to the description of that special purpose financial reporting framework in the financial information. So sometimes financial information may be required to be compiled for its holding entity, which is not in India. Now, in that case, the AFRF may be a actual special purpose financial reporting framework. And if it is a special purpose financial reporting framework, a statement and a description of that framework needs to be mentioned in the practitioner's report. Identification of the financial information, including the title of each element of the financial information, if it comprises of more than one element, and the date of the financial information or the period to which it relates has to be mentioned. Further, continuing with the elements of the practitioner's report, a description of the practitioner's responsibility in compiling the financial information, performance in accordance with SRS and ethical requirements have to be mentioned. Again, just point to be noted, independence is not a ethical requirement for SRS. Apart from independence, all the ethical requirements as per SQC1 need to be complied with. Explanation that since it is not an assurance engagement, the practitioner is not required to verify the accuracy or completeness of the information provided by the management for the compilation. And accordingly, the practitioner does not express an audit opinion or a review conclusion on whether the financial information is prepared in accordance with AFRF. So ultimately, even at the time of reporting, we as practitioners have to specify in a report that we are not required to verify the accuracy or completeness of the information. We have simply done a compilation job of whatever information was put in our hands. If the financial information is prepared using special purpose financial reporting framework, describe the purpose for which the financial information is prepared, and if necessary, the intended users, or contain a reference to a note in the financial information that discloses the information. And draw attention of the readers to the report to the fact that the financial information is prepared in accordance with special purpose framework and the information may not be suitable for other purposes. Now, this becomes extremely crucial when the financial information is prepared or when the financial information is presented in accordance with special purpose framework. In that sense, this last line becomes extremely important. We need to draw attention to the fact that this compilation engagement may not be suitable for any other purpose other than the special purpose framework for which it has been prepared. Apart from that, the basic elements would be the date of the practitioner's report, the practitioner's signature, and the place where the practitioner is signing. Also note to be noted, the practitioner shall date the report on the date the practitioner has completed the compilation engagement in accordance with this SRS. What I've done is I've just given an illustrative engagement letter for compilation engagement. Now, all this material is very widely available in the SRS itself. Just to briefly point out a couple of paragraphs and couple of sentences in our responsibilities. Our responsibilities in the sense, practitioner's responsibilities. A compilation engagement involves applying expertise in accounting and financial reporting to assist you in the sense the management and those charged with governance, in the preparation and presentation of financial information. Since a compilation engagement is not an assurance engagement, we are not required to verify the accuracy or completeness of the information you provide to us for the compilation engagement, or otherwise to gather evidence to express an audit opinion or a review conclusion. This will be specifically mentioned in the engagement letter. Accordingly, we will not express an audit opinion or review conclusion on whether the financial statements are prepared in accordance with the basis of accounting you have specified as described above. So as such, as we are the persons who are only simply compiling the engagement and we are not expressing an audit opinion, this needs to be covered and captured at the time of engagement letter preparation itself, at the beginning of the assignment, so that later on responsibility is not shifted from the management to the practitioner. We will perform the compilation engagement in accordance with SRS 4410. SRS 4410 requires in undertaking this engagement, we comply with relevant ethical requirements. For that purpose, we are required to comply with the ICAI's Code of Ethics. So today, any entity or any small, medium-sized practitioners who are engaged in outsourcing activities where they are the ones who are preparing financial statement and they are governed by ICAI, this standard will become applicable, SRS 4410, and they will need to provide a report as per SRS 4410. Your responsibilities, again, your responsibilities out here becomes the management responsibilities. The compilation engagement to be performed is conducted on the basis that you acknowledge and understand that our role is to assist you in the preparation and presentation of financial statements, in accordance with the financial reporting framework you have adopted. Accordingly, you have the following responsibilities or overall responsibilities that are fundamental to our undertaking the compilation engagement. First, the responsibility of financial statements and preparation and presentation thereof in accordance with financial reporting framework that is acceptable in the view of intended use of the financial statement and of the intended users. So, as such, the ultimate responsibility of adopting the correct financial reporting framework lies with the management itself. But as practitioners, if at the beginning of the engagement we do not come to a mutual understanding that yes, this is the framework that is acceptable, then we should withdraw, not undertake the engagement. Responsibility for the design, implementation, and maintenance of such internal control as you determine is necessary to enable the preparation of financial statements that are free from material misstatement, whether due to fraud or error. Again, internal control preparation remains the management's responsibility, and responsibility for accuracy and completeness of the records, documents, and explanation provided and other information you provide to us for the purpose of compiling the financial statements. The ultimate responsibility for accuracy and completeness is always of the management. This will not be the responsibility of the practitioner. The responsibility for judgments needed in preparation and presentation of financial information, including those for which we may provide assistance in the course of the compilation engagement. And our compilation report, of a frame of reference has to be drawn through what can be the form and content of the report. So as part of our engagement, we will issue our report attached to the financial statements compiled by us, which will describe the financial statements and the work we perform for this compilation engagement. The report will also note that the use of financial statements is restricted for the purpose set out in the engagement letter, and that use and distribution of our report is provided for the compilation engagement is restricted to you, the management of ABC company. So this is just an illustrative engagement letter that is given as per the specific SRS. This can be taken as a base to prepare the engagement letter. And of course, it can be modified to include whatever terms and conditions are specifically required and necessary for the case, especially in the case of special purpose financial reporting frameworks or some special purpose framework. This engagement letter may need to be modified. Let us just understand one illustration I've just taken as an example. The practitioner's report for engagement to compile financial statements using general purpose financial reporting framework. The general purpose financial statements required under applicable law that specifies that the entity's financial statements are to be prepared by applying accounting principles generally accepted in India. So this is a very common case where the CA firm is engaged to compile financial statements from the available information. Now, in that case, when the CA firm is engaged to compile financial statements, they automatically have to comply with this particular SRS 4410, and they will need to issue a report under this SRS. The report relatively is very small. So if we see accountant's compilation report to the management of ABC company, just 1 second. Yeah. We have compiled the accompanying financial statements of ABC company based on information you have provided. These financial statements comprise of the balance sheet as at so-and-so, statement of profit and loss and statement of cash flow for the year that ended, and a summary of significant accounting policies. So here we are identifying the elements of the financial statements that we have compiled with. We perform this compilation engagement in accordance with the SRS, giving reference to the specific standard which we have complied with. We have applied our expertise in accounting and financial reporting to assist you in the preparation and presentation of these financial statements in accordance with the accounting principles generally accepted in India. We have complied with relevant ethical requirements as well. These financial statements and the accuracy and completeness of the information used to compile are your responsibility. Your, in the sense, again, is the responsibility of the management. This is not the completeness and accuracy of the financial information is not the responsibility of the practitioners. Since a compilation engagement is not an assurance engagement, we are not required to verify the accuracy or completeness of the information you provided to us to compile these financial statements. Accordingly, we do not express an audit opinion. So this has to be very specifically mentioned in the practitioner's report that we do not express any audit opinion or a review conclusion on whether these financial statements are prepared in accordance with accounting principles generally accepted in India. Very clearly, this has to be coming out in the practitioner's report. Again, coming to the end of our presentation, whether UDIN is required on provisional financial statements or on compilation of information, this is a very common question that we often get. Where the answer is that yes, the member has to comply with SRS 4410 while preparing provisional financial statements or compilation of information, and has to obtain UDIN for the same. Just to summarize what we have understood in the standard on assurance engagements and the standard on related services. Standard on assurance engagement SAE 3400 is much different from valuation. In SAE 3400, we are just examining the prospective financial information. We are not arriving at a value of a company. So there is a major difference. In SAE 3400, we often give a moderate level of assurance in the form of a negative assurance that nothing has come to our attention that causes us to believe. SQC1 compliance is also required in the case of SAE 3400. And relevant compliance with Chartered Accountants Act is required, where we need to mention what are the sources of information used, what are the basis of assumptions, and we need to keep a statement that we do not vouch the accuracy for the same, for the prospective information. In SRS 4410, as part of SRS 4410, it is not an assurance standard. So we do not provide any specific assurance, not even a moderate level, low assurance. No assurance is given in 4410. Specific point to be noted, there is no requirement of independence in the case of 4410. Because even though the entire SQC1 is applicable, in 4410, there is no requirement of independence. Also, it does not address the additional activities that the practitioner may perform to assist the management in other areas in advance of compiling the entity's financial statements. So like I just briefly discussed, a small medium-sized practitioner may also be involved in maintaining the books of accounts of the entity and collating the information, classifying the information, passing them through the correct accounts. SRS 4410 does not address those additional activities which preclude or which are done in advance of compiling entity's financial statement. But SRS 4410 specifically covers only the compilation of financial statements. So even though you may be a CA firm or a practitioner who is providing outsourced financial accounting or outsourced accounting services and is maintaining books of accounts, but at a later stage are also compiling the financial information, the compilation of financial information will be covered with this SRS. The activities before the compilation of financial information will not be covered by this SRS. So that is it in the summary section. Thank you. Yes, Anilji. If there are any questions, we can take it.
Yes. Can you hear me, sir? Can you hear me, sir?
Yes, sir.
Sir, there are 2-3 questions received so far. Sir, first question is, can we use SRS 4410 for compilation of prospective financial information?
SRS 4410 may be adapted as necessary for compilation of prospective financial information. So in the scope para only, first it mentions that it is applicable only for historical financial information, but it may be adapted as necessary for prospective financial information.
Okay, sir. So what is your thoughts on the delay in the compilation compliance by the businesses as the tightening is lagging or prevalent from the government? Means since RBI has already clarified the issue regarding certification of prospective financial statement by CAs. Although various banks, including their branches, require that all financial statements should be certified by a practicing chartered accountant, and the clients always insist for issuing regarding this. So kindly clarify, sir, this.
Actually, Anilji, can you please repeat? I didn't understand the.
Just.
Yeah.
Sir, since RBI has already clarified the issue regarding certification of prospective financial statement by chartered accountants.
Right.
Although various banks, including their branches, require that all financial statements should be certified by practicing chartered accountant, and their clients always insist for issue regarding this.
So, I mean, certification of financial information can be done as per SRS 4410 when we are under the purview, where the firm is under the purview of ICAI. But relevant caveats will need to be provided in the report, just like a basic audit. If we conduct a normal statutory audit, we still mention in our audit report that the responsibility for preparation and presentation is of the management. Even in the case of certification, if the auditor is certifying, these items need to be given. And also there may be a reference which may be required to be made on certificate for special purposes. So that also needs to be kept in mind at the time of certifying the financial statements.
Okay, sir. Okay, sir. Sir, one general observation and seeking your opinion. What is, in your opinion or your thoughts on the delay in the compliances by businesses, as that tightening is lagging or very lethargic? It's still required. To compulsion is still required.
I mean, okay, so like, what we have been facing also in the current year, I think the entities have not yet come out of the COVID era, where if you see in 2020, the AGM was postponed till December. In 2021, the AGM was postponed till November. So we had actually additional time to do all these compliances. And now suddenly we are seeing that the regulators have made up their mind that they are not going to give any extension. So in that case, yes, there has been a little lethargy on behalf of the entities, but I mean, we have no option but to push and to help them wherever required.
Okay, sir. Okay, sir. So thank you so much, sir, for sparing your valuable time. And even after having the bad throat and ill health since last 3 days, you have covered the whole topic in a very efficient manner and in a very continuous manner. From the core of my heart and on behalf of Auditing and Insurance Standard Board, I extend my heartiest thanks towards you for this wonderful deliberation and sparing your valuable time apart from, in spite of having the ill health. Thank you so much, sir. Thank you so much, sir.
Thank you, sir. Thank you, ICAW.
Thank you. Namaste. Namaste.